Hello from DreamLadder Capital Desk. Welcome to our in-depth analysis of sectoral exposure adjustments by mutual funds during August 2024. Equity mutual fund inflows rose by a modest 3% in August, reaching 388,239 crore, up from 3,713 crore in July. Despite the slower growth, this marks the second highest inflow of the year, following June's 4,608 crore. Strong inflows, coupled with a rally in the equity market, propelled the assets under management of equity schemes to rise 30 trillion for the first time in August, now accounting for 45% of the industry's total AUM. Just a decade ago, equity mutual fund AUM stood at a mere 1.9 trillion, highlighting the significant growth over the years. Retail investors' growing participation through MFs has reshaped the ownership structure of Indian-listed companies. According to DAM Capital, domestic institutional investors now hold a record 16.9% of Nifty 500 companies as of June 2024, while foreign portfolio investor ownership has dropped to 18.8%, its lowest in nearly 12 years. In the Nifty 50, foreign portfolio investor ownership fell by 40 basis points to 24.5%, whereas mid and small cap stocks saw slight increases in FPI holdings, now at 16.0% and 12.4% respectively. FPI free float ownership has steadily declined from a peak of 48% in March 2021 to 39% as of June 2024. Conversely, domestic investors, DIIs and individuals now control nearly 53% of the float, with DIIs accounting for about 35% and individual investors about 18%. Mutual funds have made notable adjustments to their sectoral exposure recently. They have reduced their holdings in sectors such as banks, auto and auto ancillaries, infrastructure, and real estate. In contrast, they have increased their exposure to IT, pharma, healthcare, financial services, insurance, and consumer goods. These shifts likely reflect a strategic rebalancing towards sectors with strong growth potential and defensive qualities amid evolving market conditions. MFs have bought HDFC Bank, Infosys in large cap and flexi cap categories. In the mid-cap segment, they bought Voltus, Persistent Systems, PFC and Zomato. On the sell side, they reduced exposure to Tata Motors DVR, Dabur and Bajaj Finance in the large-cap space, as well as Tata Motors DVR, Thermax, IndusInd Bank and Tata Steel in flexi-cap categories. In the mid-cap category, they sold off positions in SBI, SKF, Navin Fluorine and Escorts. Mutual fund houses have varying sector exposures across key industries. In the banking sector, SBI MF, ICICI MF, Kotak, AXA UTE, Canara Robeco and Tata maintain underweight positions, while HDFC MF, Mirae and Franklin hold significant overweight positions compared to the BSE 200 index. In the IT sector, Tata MF, Franklin, UTI, Mirae, Kotak and Axis have overweight exposure, whereas SBI, DSP, Nippon and ISCI remain underweight. In pharma healthcare, nearly all top fund houses hold overweight positions. For auto and auto ancillaries, most large asset management companies are overweight, except for Nippon, Mirae, Tata and Franklin, which are underweight in this. How have mutual fund houses adjusted their cash levels? Asset management companies like Quant MF, Parag Parikh, Motilal Oswal MF, White Oak MF have significantly increased their cash positions by 6 to 8% of their equity AUMs at the end of August, compared to the average cash levels over the previous 7 months. In contrast, mutual funds such as SBI, ICI Pru Mutual Fund, Nippon MF, Invesco MF have made more modest adjustments, raising cash levels by 1 to 2%. Raising cash levels in the Indian equity market can indicate a cautious approach by fund managers, particularly in times of market volatility or uncertainty. It provides flexibility to capitalize on future buying opportunities when valuations become more attractive, or to cushion against potential downturns. Higher cash positions may reflect concerns over market overheating or global economic uncertainties, signaling that fund managers are preparing to strategically deploy capital in the right opportunities. Remember, knowledge is power, and we're here to empower you to make smart, informed investment decisions. So stay tuned to DreamLadder for more market insights, analysis, and of course, our signature brand of straight talk.